You open your Super app, see a $20,000 balance, and think, great, when I leave Australia, I'll have a 20 grand head start back home. That number on your screen is an illusion. When eligible temporary residents permanently leave Australia, they claim their super through a Departing Australia Superannuation Payment, or DASP, and before that money ever hits your bank account, a final withholding tax is taken out. This flowchart shows what actually happens to that $20,000. Under the standard DASP test rate as 35%, your net payout drops to $13,000. But if you held a Working Holiday Maker visa, like a subclass 417 or 462, the tax rate on the taxable component jumps to 65%, leaving you with just $7,000. DASP operates entirely independently from normal retirement withdrawals or financial hardship release. It is a specialized, rigid payment framework designed exclusively for departing temporary residents. Because it is a final withholding tax, you cannot get this money back by lodging an ordinary annual income tax return. Once the super fund deducts the DASP tax, that portion is gone. Expecting a $20,000 windfall and receiving $7,000 creates a massive financial shock. Understanding this final tax mechanism now is the only way to prepare for what you will actually receive. You cannot claim DASP simply because you stopped working. You must have accumulated super while on a temporary visa, you must have physically left Australia, and your temporary visa must have officially ceased. This bar chart breaks down a typical superannuation account into its 3 possible tax components. We start with the tax-free component on the left, which has a DASP tax rate of exactly 0%. Next is the taxable component's taxed element. For standard temporary workers, this section is hit with a 35% DASP tax rate. This is the most common component in standard employer super accounts. Finally, we have the taxable component's untaxed element. This arises in specific fund structures and carries a standard DASP rate of 45%. If your account is subject to the Working Holiday Maker rules, the tax rate on those same taxable components jumps to 65%. The Australian Taxation Office checks your entire immigration history with Home Affairs. Even if you later move to a graduate or student visa, having held a previous working holiday visa can trigger the higher tax rate on your payout. Assuming you will pay a standard 35%, or confusing DASP with the 15% income tax you paid on your weekly salary, leaves you completely unprepared for the actual statutory deduction on your final super payout. This side-by-side comparison shows 2 workers with identical $18,000 taxable balances. Fatima worked on standard temporary visas. At a 35% tax rate, she nets $11,700. Lucas held a 417 working holiday visa. At the 65% rate, his exact same $18,000 gross balance yields a net payout of only $6,300. Nora's payout looks different. Her account includes a $2,000 tax-free component alongside an $8,000 taxable element. The 35% standard DASP tax only applies to the $8,000, leaving her tax-free portion entirely untouched. Ahmed holds accounts with 3 different super funds. He will need to submit multiple DASP applications, and each fund will calculate its own tax deduction based on the specific composition of its account. May tries to claim DASP from overseas, but her temporary visa is valid for another 5 months. Her claim is blocked until the visa officially ceases. Daniel worked on temporary visas for years, but recently gained permanent residency. Because he is now a permanent resident, he generally falls under ordinary Australian super rules rather than the DASP framework. Sarah left Australia 3 years ago. When she checks her old fund, her balance reads 0. Her money isn't lost. As a former temporary resident, her inactive balance was likely transferred to the ATO as unclaimed super, where she can still claim it. Because these factors interact, your final net payment depends on the specific combination of your visa history and fund structure. Before you pack a single bag, verify your employer's payday super contributions. Compare your pay slips against your actual super fund transactions while you are still physically in Australia and have easy access to your records. You might consider consolidating multiple super accounts to save on administration fees. Review this carefully first. Combining accounts can immediately cancel valuable life, disability, or income protection insurance policies held inside those funds. Update your personal details across all platforms before you fly. Change your registered email to a personal address.
Record your exact passport numbers and set up alternative multi-factor authentication methods so you aren't locked out of your account when you cancel your Australian phone number. Be highly skeptical of online services promising to recover your super for a percentage of the payout. The official ATO application system is free. Do not hand your tax file number, passport details, or MyGov login to unverified third parties. Completing these administrative checks while you're still in Australia secures your account access, protects your remaining balance from processing delays, and shields you from predatory scams. Once your plane has taken off and your temporary visa has legally ceased, you can use the official ATO online DASP system to verify your identity and submit claims directly to your super funds. The official system outlines a general 28-day turnaround, but delays happen. If your passport changed, your name changed, or your fund requires certified physical documents to release a large balance, processing will take longer. When the money clears, scrutinize your final payment statement. Verify the gross DASP, check the specific tax withheld against your components, and if your visa history is complex, consult a registered tax agent to review the calculations. The tax rules and thresholds discussed here are current as of the 11th of August, 2026. This is educational information regarding the Australian federal superannuation system, not individual financial or migration advice. The DASP framework extracts a heavy statutory tax toll on departing temporary residents. Mastering the legal rules and organizing your records early is the only sure way to safely recover the remaining funds you rightfully earned.